All right. So it's not Forex Fridays. You can say this is Forex Saturdays, but we're going to go over the weekly range review. We're going to look at some Asian session models that happened recently, and we're also going to look at some smash model ideas that formed in the most recent weeks. So to begin with, I'm on the hourly. I have it transcribed as Sunday, Monday, Tuesday, Wednesday, Thursday, Friday. So you got all the days there. Now, to begin with this, we're going to talk about this line here, this opening price here on Sunday, SOP. So SOP is the acronym. Sunday's opening price. Now, anything above this price line is a premium. Now, I'm going to engage the chat. I'm going to ask you guys some questions. Is it ideal to find buying conditions or selling conditions above the Sunday's opening price? Anybody can answer that. Selling. Yes. It's more ideal to find selling setups. Now, I'm not telling you that you cannot find buying opportunities in a premium. It's just more ideal. When that situation finally arrives and the market drops down, more times than not, you're going to see it's forming in a premium. Now, the same thing would be said vice versa. That means if it's ideal to sell above Sunday's opening price, that means it must be ideal to buy below Sunday's opening price and a discount. So buying opportunities are best here. Now, just looking at it from hindsight, just look at the chart. Monday was the low of the week, and Friday was the high of the week. Very opposite ends here. We can see where the best buys occurred and where the best sells occurred. The best buy was definitely here this London session during Monday. Again, even New York session here, Asian session as well. Tuesday, London session, and possibly also a New York session again. Now, late afternoon, there was an opportunity. This might have been news. What is this? Probably the rate decision. And then so on, the price continued going up. And there's some selling conditions here too. We'll talk about it. But I just want you guys to understand conceptually, your best sells always going to form above the opening bid of the week. This is the weekly chart just transcribed on the hourly. It's no different. It's just a lot more data, right? That large candle that we see up on UJ right now, we're about to dissect that. All the data that happened in here, all the intraday models. So let's take a look at that. So let's go down to the 15-minute time frame, and let's go back to this London session. Now, I know you guys can see my session indicators. Whenever you see this is Sunday. For some reason, the indicator signifies or marks off Sundays like this. You'll see if I keep going back, that's another Sunday. I don't trade Sunday Asian session. I do not. It's not worth my time personally. Now, Monday is not an ideal trading day, but if there is news or if there is some type of press conference, you can trade that day Monday. But however, midweek, Tuesday, Wednesday, and January, Thursday, sometimes Friday, that's where all the volume's coming in. Those are ideal days to trade on. But I want you to take a look at this Monday session. Now, I haven't gone through it myself. This is my first time watching it. So we're going to go through it together for the first time. So we have our dead zone. Can someone tell me, what do we define this as? What phase in the market would you call this? Like, out of all the four phases, we know there's four phases. What out of those four phases would you call this? This price action here. Consolidation, correct. See the market moving sideways, right? The market's accumulating orders. It's shot down, and then all of a sudden at midnight, all this momentum that was coming into the market kind of just said, "See you later," right? It just slowed down for some reason. The market was very excited. Large range candle, right? Very large candle here. And then all of a sudden, it stopped producing large candles and started getting lethargic, moving sideways. Now, what pattern does this look like if you're a retail trader? I want to see if anybody has a good eye on this. What pattern does this look like? This long thing down and then this consolidation. What would you call this? I know somebody knows for sure. You guys are intelligent. What retail pattern does this look like? It shoots down and then all of a sudden it starts moving sideways. It gives you guys a few seconds. Somebody might answer it. We'll see. Yes, this is consolidation, but I'm talking about this. Yes, bear flag. Don't put a question mark after it. You're correct. Say it confidently. Yes, a bear flag. Absolutely, my friend. That is a bear flag. You guys are correct. This is consolidation. But my question was, what retail pattern does this look like? It's a bear flag. My man, you got that right. Good job. Right, you're thinking. This is a bear flag. And what do retail traders like to do when they get these bear flags? Look to sell it, right? Break retest, go short. That's what they're looking for. But there is moments in the times where we know the market does give fake outs. And those fake outs definitely can occur around these retail patterns, right? A false bear flag. Now, even though we'll get that pattern, retail traders will get this pattern and it'll break. And then it will look like it's going to shoot lower. I watch. You'll see. The London model, right? The model that I pretty much provide the community with. And I'm not saying I'm the first one to discover it, but I'm definitely trying to put it out there, you know? Someone else might have discovered it before me. Who knows, right? But I'm here trying to educate everybody as much as possible how I like to trade and what I've discovered at least. So there's a dead zone between the kill zones. And I like to see when the market starts in consolidation because we know ICT had mentioned, right, to new traders, all markets start in consolidation. That is your perfect time to look at the market because everything is quiet before the storm. And the market's going to execute and move towards one side of that market and probably try to change direction after breaking it. That's all we're looking for. So I'm looking for 15-minute swing highs and 15-minute swing lows or clean highs as well. Right? Anything that's relatively clean is what I'm going to be looking for or looking at. It's here. I wonder why my music stopped. So we got our 15-minute swing high, 15-minute swing low, and we're going to wait to see which side of the market is broken. Now, where are we according to Sunday's opening price? Are we below it or above it as we're heading into London session? We're below it. So we're in a discount. So what should you start to think and anticipate in your mind? Should we be looking for the longs or should we be looking for shorts? Somebody call me. Back to the chat. Exactly. We're looking for longs. Exactly. So we're looking for those long ideas. We're going to see price go higher. There we go. Someone's asking for the link for the Zoom. All right, there we go. We're looking for longs. So if we have that in mind, we're below Sunday's opening price. We're looking for longs because we're oversold. We're looking for buying conditions. Now we're already framing ourselves, right? See how we start to check off the boxes, right? We have a step process to this idea. It's not perfect, but it is systematic though, right? It's a very systematic approach. Are we in a premium or a discount? Okay, check. What's the next list? Okay, if we're in a premium, we're looking for sells. Okay, if we're in a discount, we're looking for buys. All right, how are we looking for those buys now, right? Since we're in a discount, what's the next step? We're looking for buys. We're looking to buy either during the London session or the New York session and even possibly the Asian session later that night. That's all we're looking for. Buying opportunities during London or New York. Most times you're going to see the market raid the counterparty liquidity pool that you need for the longs, meaning it's going to run out sell sides or swing lows or clean lows. Anything below these blue lines that I have, and I'm always taking the ones that are unbroken. See if this is swing low. This is also a swing low. So mark that off. 2 a.m., 2:15, right there. That's that swing low. 1, 2, 3. Right. We even have a what? No, that's not a swing high. Okay, we don't have a swing high. So our recent swing high is here. There's another one that's just below it. And this is how I like to draw it out because it makes things a lot more clear for people that are watching. You just think of it of orders, right? Or stop orders or money. Here, there's one down here, and there's one here. Now we got the opening price of the kill zone. This is our next step, right? If we're a London trader, we have time to trade the London session. This is what we're looking for now, because we already said step one. Where are we going into London session? Are we below the weekly open? Yes, check. All right, so that means we're in a discount. Since we're in a discount, that means it's ideal to buy because we're in oversold conditions or oversold market territory. We're going to be looking for longs now, not shorts, because it's beneficial to us as the buyer to buy lower on the weekly candle as it's going down. Now it sounds like a contradiction, right? Some traders that are new to trading, they're like, oh, why would I buy the market while it's going down? It almost feels scary, right? You're like, you see it's going down. Why don't you just sell? Well, that's not how the market is always going to be designed. And if you take like I said, if you take a very objective measure, we know that many times when a candle finishes up, there was at least a move that went down first before it went up. We can all come to that same conclusion. Same thing, vice versa. If we had a weekly candle that went down, at some point in time during that weekly candle, one of those days was up. Whether it was Monday, whether it was Tuesday, Wednesday, even Thursday, one of those days had to have been up for the market to finish down. If we take that same idea as a fractal idea, this is London opening price. So LOP, right? This is 2 a.m. Same thing. Anything above it, it's a premium. Anything below is a discount. I'm taking my time. I'm trying to show you guys all the annotations, right? So it makes sense. Discount. This is a premium. So the same thing applies here. Same thing applies here for the kill zone. We also have midnight opening price here. I'll draw it a little further out. The acronym I like to use is MOP, right? LOMOP. Midnight opening price. And that same thing here. Of course, trading view. So difficult to work with sometimes. So we got that there. So now we can look for a triple confluence idea, because the single confluence was us being below the weekly open. Now if we're looking for a buyer, we're looking for more confluences. We wanted to at least give us 2 out of 3. A 3 out of 3, you're probably looking for a home run. Solid. And we'll see that as the weeks go on. Let's play it forward and see what happens first. So immediately, right now, boom, 230 candle, price pushes down very strong. Takes out sell side. Bang. Right? We need volatility. We need the market to move. We don't want the market to stay in the consolidation. So we've now recently taken out sell side. Let's leave one sticker for one side. Now the other side becomes our target. Any of these two levels here become our target. Even the short-term ones that are making here, like lower swing highs here, they're probably going to be our target to the upside too. You can see now currently, is price in a triple confluence idea? Yes or no? Based on all the ideas that we talked about. It is. Thank you. All caps. Yes, it is. It's in a triple confluence idea. 3 out of 3 here. At this point, what I like to do is go down to the 1 minute time frame. Now, I don't actually trade the London session, right? Being very transparent with you guys. I don't trade the London session. I'd be sleeping. I live in New York. I don't have the time to trade that. So even though I don't trade it, I go back and study it because they're all the same. All the kills are the same. They might have a little different phase or different characteristic to how they frame the day, but they all come down to the same patterns. But there's a handful of patterns that they always give traders to look at. Price takes out the sell side here and here. What I'll be looking for is a change in direction or a change in delivery. So the market's going down. I want to see some type of swing high broken, or maybe some type of inefficiency to the upside, right? Something very large, speed to the upside. At this point, they got retail traders probably chasing these shorts. Like I said, that was the flag, right? This little flag here, like this, not drawn to scale. People looking for that breakout, sell off. But most times it can be a false bear flag. And you get that sell off, and then it changes trend. There's a reversal. And we're gonna look for an entry. We're gonna play it forward till we get to the entry. My favorite thing when I teach people one-on-one too, and we're looking for the entry, I tell them this is what the entry looks like, right? I show them the fair value gap, I show them the swing point, etc. Right? What it looks like, I explain. There's a fair value gap. It takes 3 candles to make a fair value gap. The low of that candle, the high of the other candle, and you got the space in between. That's your fair value gap. Then I show them what a swing high is, what a swing low is, and how to define that. And I like to play it forward candle by candle. And I tell the trader, right? Tell the student, I'm like, tell me when to pause it when you see the entry. And it's a very funny thing to see as me as a teacher. And most times the entry is right there, and I'm just still clicking forward, right? And they haven't told me to pause the chart yet. And then I'm like, hey, we're going a little too far, right? We missed the entry. It's right here. And then they're like, oh, aha, right? The light bulb goes off. They're like, oh, I see what you're talking about. And we do it over and over and over and over. And it's pattern recognition. You start to pick up what the entry looks like. Now, I'm not saying this entry forms every single day, but it forms very frequently in many other pairs and many other asset classes as well. Gold, crypto, stocks as well, right? Futures, it will form there. All these markets are literally the same. And there goes our entry right here to here. That's our entry idea. We're looking for a long idea here. We can also see that there's higher highs and higher lows starting to print, right? Especially here. Let's bring it back. We don't really get a strong impulse to break that swing high, but I'll show you here. So you can see how price comes down. And the change in delivery, all we're looking for is what a bullish trend or bullish leg looks like. In very simple terms, a bullish trend or bullish leg is higher swing high, higher swing low. There's nothing else more to it. There might be a start of a false break going into it, or there might be a fail of a break of a low going into that trend, right? Either get a breaker or you get some type of mitigation, and the new leg starts to continue. So play it forward, and you can see, look how price stops here, right? It doesn't sweep this swing low that it just forms. There's sell side down there. For some reason, it fails to break it. It stays up. Then, right, we keep playing it forward. There's a swing high up here. Watch this swing high. Right, that's buy side. That's sell side. Let's play it forward. We break it. After breaking a swing high, if you know the bullish trend formula, there should be no surprise to you. If you watch that 3-part video on YouTube, daily bias recognition, right? It's on YouTube. What is the bullish trend model? Can anybody tell me what that is? Let's see if anybody in the chat is familiar with that. What is the bullish trend formula, right? What is the model or the variables that make up the formula? It's this plus that equals this, equals bullish trend. Okay, Arnold says swing low broken. Okay. Still cold. Okay, yes, swing high broken. Higher swing high. Okay. That's, yep. Kimberly close. Switch that last word lower, right? Higher. There you go. Higher swing low. Good job, guys. Way to get to the answer, right? That's your bullish trend formula, right? It is going to be, I'll write it out, right? Bullish trend equals what? Higher swing high. Well, actually, this is how it goes. Swing high broken plus higher swing low. That's your bullish momentum or your bullish trend. That's how it normally would start. Now, sometimes there, like if we go a step back, like sometimes there is a break. The market could have done this first before breaking this swing high. I want you guys to understand there's different scenarios, right? It could have broke the low first and then went back to that high, right? Get that breaker, or you get that mitigation instead. Price comes up, fails, goes up, turns into that high, goes higher. You get that instead of the breaker, right? Boom, 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 here, up instead. So there's different ways, like I like to say, see the two scenarios it's going to form. It's going to be a fail to break a low, and then you start seeing the higher swing lows form in and the higher swing highs form in. Or it's going to be a break of a low, then you start to see a very vast change in direction. So if it would have broke this, you'll look to see how dynamic it would run back up to get to this high, right? How long it would take to get back up there. Does it happen dynamically? Does it happen slowly? Is it lethargic? Price failed. It got really close, and it printed 1, 2, 3, pretty much 4 candles. We'll say this doesn't count. 4 candles back to the upside real quickly after putting 3 large candles down. That's quick repricing. Very quick repricing. There's little signs. It's showing you here. Failing to break the low. And I like to equate swing high being broken. That's when, right, when I do it on the bullish chart or the daily chart, I put this here. Because I'm like, oh, pay attention. Something's going on. We have a swing high being broken. We must see probably a higher swing low. Let's wait to see what happens. We play it forward, and we get a higher swing low. So after that higher swing low on the daily chart, right, the same thing I'm telling you is how I find the daily trend. Just pretend that all these candles were daily candles instead. I know we're on the 1 minute, and all these candles represent 60 seconds. But if we just thought about this same time frame and pretend it was a full Forex schedule, right? A full trading day, each one of these days, open and closing, right? A Monday, a Tuesday, Wednesday, Thursday, Friday, right? It's the same thing. It's no different. If we pretend that these were daily candles instead of 1 minute candles, same thing. So it's bullish trend. There's the formula. After this higher swing low, what could you do? What are some ideas that I tell you guys on the daily chart? What could you do after you confirm the bullish trend? What's my favorite and most infamous way of getting into a bullish trend? After what? Higher swing low. Yes. Yeah. Fair value gap. Yes, that too. Something more simpler than that. These are good answers. We're in a bullish trend. When you normally see me take swing trades, when am I taking it after? There you go. Down close candle. Good job, my man. Good answer. Absolutely. Right? Correct. Confidently. Say it confidently. It's a down close candle. Good answer. I like to buy after a down close candle. Shout out to that man. Good answer. Price is very fractal. Exactly. It's so fractal. It's the same thing that we're seeing on the daily chart being shown on the 1 minute, but I'm telling you, to conceptualize it, right? For some people to really get the true understanding. Once you understand this, you're like, wow, the way they created this market was insane. Very insane. It's like the same way you plant one sunflower seed, right? That one sunflower seed potentially has the whole family tree, right? That lineage, right? That one seed is going to produce another 300 plus seeds, 500 plus seeds. I'm not sure how many seeds are on the head, but I know it's a couple hundred seeds, depending on how big the sunflower head gets. You're going to get tons of seeds again. And it's the same thing over and over. Each one of those seeds become a single stalk sunflower or multi sunflower and etc. It's the same thing. I would like to buy after a down day or a down candle. You could take that same idea. It's not gonna be as perfect as the daily chart. Daily chart itself is not even perfect either, right? You saw me guys buy on GJ on that long position and was in some drawdown for a bit. Right? Let's take a look at that real quick. I know I'm jumping topics, but I'm telling you tonight's gonna be a very thorough explanation to how I do things. You start to really understand it. Open this in a new tab. Make sure you guys can see this chart. Everything I'm about to show you on that 1 minute chart is happening right here on the daily chart in the swing trade that I'm in. Everything. Daily chart. Come here, reset. Pull this up here. Share this tab. You can see it right here. Look how price. This is a smash candle. Top left. Bring this in so we can see it. That's a smash candle. I brought after a down day, pretty much. I did have drawdown, and then it pulled up. I know we don't have the full bullish trend formula here, but it's a little more advanced, right? Me taking an educated guess. Okay, this was the day I was going to buy on, and when I was going to set my stop loss, and where I set it up. And luckily, we didn't get that run on that low. This is actual swing low. You can see it created a higher swing low. I didn't know if it was going to do that, right? I took the odds. I took the guess, speculation. I could have been wrong. This could have been a losing trade. I honestly thought it was going to be a losing trade. But it came back to life in this swing trade. Perfect. Came right back up into that fair value gap that we like. Swing low with speed through it. Came right back into it. And now it's back at the September's opening price. Got all those traders short. Looks like another wave came back up. And we're able to anticipate that after a down day and a bullish trend. Let's go back to that 1 minute time frame idea. So my entry is forming right there. That's the fair value gap. No down candle. Oh, my notifications. Ooh. Turn this off. And we're waiting for what? Price to come down back into this fair value gap. Now, I don't know if I'm going to get that fill. We have to wait to see if we get that fill. Now, you can wait for a market execution. You sit here patiently. When the market goes down in there, you click buy. Or if you have the time to set up, right, a buy limit order real quick, set it up. So when it hits it in, you're automatically set in. You don't have to do nothing. Wait forward, and boom. Do we even touch it? Looks close. Nope. But this is a down candle. Now think about this. Now I'm just going to point out this down candle. It's the first down candle here. I got to turn on do not disturb. Okay. And do not disturb here. Down candle. Could buy after this down candle. Stop loss is going to be where? Probably under the most recent swing low that we formed. Because we're going to make the assumption that this swing low is going to be protected now. Hopefully you're still following me. We're assuming that this swing low, the market doesn't want to raid. The algorithm should not want to raid that. It can though. Like we can't control the market, but if we had to go long, just some quick projections, right? Quick framework. Where would you put our stop loss? Below this swing low. It's our safest bet. Everyone's taught to do it that way. There's no special way. Right below that swing low. If it's not that one, then maybe this one, or even the lowest one we have down here. But the assumption is these swing lows should be protected after the change in delivery here and a change here too, without entry idea. There, we're not long. So we take that 1-to-1 idea. And I want you to count how many down candles we get before going into profit. Got another down candle here. So we're long. Multiple down candles right here. Another one here. Another one here. There you go. Another one here. And here. This trade got stopped out, unfortunately. I didn't know. Now we both can see that this market is not perfect, right? Everything we set up may not always come to fruition. Multiple down candles we could have been buying in. Losing trade. What are you going to do? You either get back in and try to mitigate your losses, or you come back tomorrow, or you go into the next session looking for New York to regain whatever you lost here. It's got to be half a percentage, right? Let's say we lost 1% on this trade. Risk protocol, right? We all were not perfect. We're going to lose trades. So this is a good time to talk about it. We took a loss here. Let's say we lost 1%. We cannot go into the next trade risking 1%. We have to be conservative a little bit, right? I don't want to be aggressive. Take the safer route. Be conservative, cut the risk. So we have to risk 0.5% or 0.25%. And as we take multiple trades and we recover that full percent, right? If it's a quarter, we had to do it by 4, right? 4 winning trades will get us back up to 1%. If we're doing it by, only 2 halves, like 0.50, right? 0.5%, it would take 2 trades to mitigate that loss. But if you're aggressive, you would take 1 trade to get it back, of course. I wouldn't recommend that because let's say you take another trade after this, you lose another 1%. Now you're down 2%. Instead, you could have been down 1.25, right? A percent and a quarter, or a percent and a half, 1.5. And now you're down 2% because you risked another full percentage your next trade. So mitigate your losses first. Do not be overly aggressive, and be mindful that nothing's going to be perfect to the way you want it. Now, you might have won this trade because you don't do a 15 pip stop loss. You might do a 30 pip. You might do a 20 pip, depending on what you're looking for. I tend to stick 1 to 115. I like it. I'm comfortable with it. Let's play it forward. 3:30 comes around. Heart of London. London session closes, and we're still below in a discount. We still did not get back up to these swing highs yet, and those swing lows that we had, that we thought were going to be protected, were then turned into targets instead. Market targeted that swing low, this one, and this one, rated all of them. And the same thing repeated again, though. Look at this. Shortly after, the same model. I'm not saying you have to go back in here looking for longs. You could if you want to, but I would wait for the next session and recollect myself after taking a loss. I don't want to jump into the market right away. I just took a loss. Some people may not be able to control themselves, right? Oh, I just took a loss. It feels like everything is against them. You know, you were on a hot streak, winning streak. Now this is a little fork in your, your hot streak. So take a second, take a breath, come back next session, or come back tomorrow. Same model forms, same idea. It's literally the same idea. It just happens lower. And we got a 1-to-1 scenario that came out of that. That would have been a successful one. So like I said, nothing's perfect, but I'm here. This is how I learn, right? I go through the motion, I go back and I study the market. Oh, there was a potential setup here. Did it work? Oh, it did. Oh, there wasn't potential setup here. It actually didn't work out as much as I thought it would. All good. Let's move on to the next day. Well, actually, let's move on to New York session. See what happens New York. Let's keep going. So let's say the London trader had a little more difficulties here. We have another session, another dead zone, and that dead zone is here. This is the London lunch. We got this here. It's still midnight. We're still gonna keep moving this forward. Fractal. We're gonna go back before 7. We're gonna mark off the 15-minute swing highs and swing lows that we have in here. Market reaccumulating again. You have a swing low here, or a low. The lowest low is here. You have a swing low here that's rated at 7 o'clock. You have a swing high here, and we have a swing high here. Just keep it neat. $7 a.m. is pretty much darn equal to New York Open, to midnight opening price. So just move this here. Put it on the bottom. Let's play it forward and see what happens. And look how price, even during this dead zone, look how it gets back up there, though. Starts getting back up to London opening price here. Traded up there. Trying to get where? To the buy side still. Just playing the range. And we were trying to anticipate when we could probably catch that turning point. You can see here, it was a loser from the way I would have framed it. Like I said, you might have had a larger stop loss than me. Swing low broken. So we'll say the same thing. Bang. Sell side was taken. This becomes our target. Buy side liquidity. So go down to the 1 minute time frame. We're going to look for entry below 7 a.m. Now, sometimes the entry is the very first fair value gap that forms. That's another one. I see that sometimes. A very quick one. First fair value gap that forms tend to be a entry idea once in a while, or the same one that we're looking for. So you can see this one here. Oh, my eyes mistaken. There's not one there. Let's play it forward. That first fair value gap falls through pretty strong. That was a steep one. It breaks another level of sell side down here. It's still below midnight, still below 7 a.m., and it's still below Sunday's opening price. Starting to get a change, or it looks like price is starting to hold price. Higher swing low formed here, and now they're starting to what? Reaccumulate the market again. You got this little bull flag thing going on here. Right, this is what retail would look at. Bull flag here, breakout, retest, go long. It's possible. It does happen. I'm not saying it's not going to happen ever. These patterns do happen to occur and play out really well too. And it looks like we don't get our entry technique. Nope. Looks like price shoots off and leaves us in the dust. This would have been it. See, it's a fair value gap. Swing point here. There's no retest either off of this after price breaks these lows here. Unless there is. Here, retest and go along. Back on this consolidation. Wait for to see maybe this is an optimal trade entry idea. And price gets to that buy side pretty quickly. And I don't think price gets back down here for the rest of the day. Honestly, I think it continues going higher. But again, the buying opportunities are forming, right? Wasn't the best. Went in looking for it, couldn't get the entry, or we took a loss that day. But the same thing, you can still see the premise of it is we're breaking one side of the range every time. Look at how London's doing it. It makes consolidation, breaks the range, and is trying to get back up here. Took a loss though that day. Same thing here. New York session, there's some type of consolidation in here. It breaks one side of the range, then it goes back up. It's that simple. That's all I'm looking for. This is just a scenario that the market gives. Every day, it's not going to give this perfect scenario, but I know sooner or later I'm going to hit, and the market's going to give me that scenario. It's going to give me that entry, and I'm going to be a winner. Period. I know I'm going to be a winner. It's just me maintaining the risk. How much can I manage the risk? Even when I take the losers, how can I manage the risk as much as possible? That's the end game. The management, the management, the management, the management, the management, the consistency, showing up, the personality that you have, the work ethic that you have. It's more than just trading. We can learn the models, we can understand the entries, but if we can't be disciplined traders, it just doesn't. You're doing all it for nothing. Let's go back to the 15-minute chart, and we'll continue to play it forward to see what we got from the market. London close. Let's play it forward. Now, normally, like I said, I normally come pre-prep. I go in, I check for the examples where they were successful. But you can see this is how I would have done the groundwork without you. I would have went in here, did the back testing. Oh, this actually failed. Okay, we don't have to talk about it because we know there's losing setups. Let's show the traders the winning setups. We all know that we're going to take losses from time to time. I don't ever shy away from that. 15-minute chart again. We'll move a little faster here. Look, swing low broken. We're below midnight opening price. We're below the weekly opening price. See, follow. Hopefully you're following. And if I'm moving too fast at any point, tell me slow down, Deontay. Can you say that again? I didn't understand. Can you explain it a different way? And I'll try my best. There's a swing low here. These are swing highs up here. So we just got some quick, easy ways to frame up buy side and sell side. You see price comes down. Does not take out buy side first. Takes out sell side first. Go down to the 1 minute time frame. We're going to stalk a long idea below the opening price of London session. Let's see. So it looks like one is forming right now, where we stopped it. That's the fair value gap. There's the swing point there. So we're looking to go long here, 1-to-1. Taps into it, and it gives us the winner. That's it. That's all we're looking for. It's London session. That's the London model. Different day, same kill zone. That's it. Same thing. And we're trying to see if it's going to get back to 2 a.m.'s opening price, our final TP, these 15-minute swing highs, and possibly back above the Asian session high. Because it would have been nice if it ran the Asian session low. It would have been picture perfect. But like I said, we can't control the market. We want to see if it's going to get it back above these highs here or buy side. Play it forward. Looks like price retests that level again. Another dead zone coming up, going into the New York session. The entry formed in a triple confluence idea too. Below 2 a.m., below this weekly candle opening price, this line up here, and then also below midnight right here. Perfect. 3 out of 3. 3 out of 3 is normally be the home runs. And the ones that can possibly allow you to hold on to into the next kill zone or next trading day, true day open. We have news this day. Retail sales, 8:30. Let's find some sell side. Find some buy side. It looks like we failed to break any swing lows on the 15-minute chart, but price breaks a 15-minute swing high. We're looking for what? Price to probably get above Sunday's opening price. Maybe give us a triple confluence sell, possibly, right? We'll see what happens. We'll go to the 1 minute. It's in a double confluence because it's above 7 a.m., above midnight right now, but it's still below Sunday. So let's see if it continues to go up. It's 8:30. Price spikes. Ooh. So it shoots up and it moves above all three at one point. And it looks to see, let me see what happens. Quick reversal, turns around. Moves back into a double confluence idea and it shoots back up. If you zoom in too, I bet you the entry that we look for possibly formed. See, this is very similar to it. There goes the fair value gap, but the swing point is on the start. Sorry, the end of the fair value gap or the premium side of the fair value gap. I don't like this entry, but I do see it from time to time. And you can see here, the price hits it. It also even trades down into other fair value gaps here. Or maybe some people might say, oh, this is a balanced price range. I feel this range in really well. So it's going to respect that area if it returns back into it. Or this is an inverted head and shoulders, right? Retail traders would say that. You got a little false break and price continues to the upside. And that was New York session. All right. And now let's play it through. We had a Tuesday Asian session. I don't think it was successful. I think it actually was not successful Tuesday night, if I'm not mistaken. quick glance. I'll do it myself. 1 minute chart, London session. It stopped out. Loser. Could tell this would have been a losing trade. Price keeps trading up. Doesn't sell down. 15-minute chart. This is Fed rate day, I believe. Yep. UJ did print the New York model. Yep. UJ printed the New York model right here. I think GJ did too the same day as well. So let's go through the model real quick. 15-minute chart. Here comes the sell scenario. Vice versa. Right, we got sell side. We got buy side. We got more buy side here. You can play it forward. You see price runs those levels. This buy side here. This buy side here. It's now moving above in a triple confluence idea. This is midnight opening price. And this is 7 a.m.'s opening price. Price is currently also above Sunday's opening price. So now we have a triple confluence of triple premiums. You could be looking for a short. Going into that news event at 8:30, you could be looking for a short. If the short forms before 8:30, then we're anticipating that this news event is going to continue or trigger our short idea. Wait forward. There it is. That's the entry. Right? 8:30 happened at 8:30. 8:30 triggers the entry perfectly. This week was, someone had said in chat, this week was a very prime example of why PD arrays are important. They're very specific points in time. How did the market at 8:30 on that high impact news event hit the entry technique that we always look for? The same one that we always look for. A swing low, 1, 2, 3. Fair value gap. Hit it perfectly too. Little to no drawdown on this entry. You play it forward. And look at that. 15 pips hit. And the entry formed prior to 8:30, prior to the news event. This thing sold. It's a London close session. See, it's a reversal to the New York session. Now you got the New York lunch. And that sell off. Ooh, that news event right there. Fed interest rate. That same model still. They didn't get stopped out. I want you to see that. That triple confluence idea, man, when you get it right, it moves. When you catch it, the tiger, you're basically catching the tiger by the tail on this trade with that entry and that stop loss too. Only 15 pips kept us alive really well on the 1 minute chart. And this is what I like to say all the time. When you see the injection of volume like that, they're making people chase price. So our model was, well, we all could agree to that, right? The model was triple confluence. It's no different. No other fancier way. I'm not trying to trick you guys. I'm not trying to deceive you. It's the same thing over and over. We can all agree it's the same thing I show consistently. Some people might be new to this, right? Some people might not still truly understand or truly believe it, but I try my best to be consistent for you because I want you to see I'm not doing anything special. There goes the entry. 15 pips hit. That 8:30 news was perfect for the entry. And then we had the news for the Feds. And then we had Fed Chairman Powell conference, right? The Fed conference after. So they kept rates the same right here. This large candles when they said, oh, no, they cut rates. Sorry. They cut rates. And obviously that was not going to be good for a dollar. Cutting rates means you're going to lower the yields. And the yields is what brings investors to your fiat currency. It's a primary backbone to fiat currency. If you didn't know, now you know. Fiat currency's primary driver for the value is the central bank's interest rate. It's one of the primary fundamentals to why currency has the value it has and why investors sought after it and why they jump into yen or why they jump out of yen and go back into CAD, or why they jump into CAD to go back to pounds, etc. Right? The trade in between them. This trade drops really fast. And I like to say, trading psychology, the average trader is going to chase this market very fast. This could have been NFP as well, right? This could have been any other news event. This news event was very impactful, though. Fed rates in general, any central bank rate decision, it's very dynamic on the market. And it's going to be a lot of volatility. You can see it happened here, especially with the Feds. Guess what traders are doing? They're chasing it short. So what could you do here, right? If you had high trading IQ, you could buy the news, right? Everyone else is going to chase it. They're trying to predict it. It's too late. This happens at a flash. You don't have no super godly reaction or reflexes to try and click sell and predict which way it's going to drop. It's hard to do that unless you're in already. And you can see this model would have had us in. You could have rolled that all the way. Look at what level it hits too. No coincidence. Look at what the level it hits. It's not a coincidence when I'm showing you guys this stuff. It's all natural and organic. Look at that. Hits Sunday's opening price. The opening price of the week, it hits again on Wednesday. So pretty much what this candle looked like at this time when this news event dropped, this candle looked flat. Right? It almost looked like it looked like a doji, not a doji, but it looked like I don't even know the candlestick pattern name. It looked like the candle had no green or black, right? It was just a line when it hit that level. It gave all those gains back up to go back to the open. And now watch this. And that's Sunday's opening price. And everybody was what? Going after these shorts. Look how quickly after the news event. Look how quickly after the news event that happens. The market changed very quickly. Everybody that was chasing those shorts, they might have been able to get a piece off, right? A little piece. They might get lucky, but you're going to get people that are very optimistic. Like, man, this thing's going to keep selling. It's going to keep dropping. It's going to retrace, and it's going to keep dropping, which is a scenario that the algorithm can provide traders with. But then there's also times where the market provides another scenario. It looks like it's going to retrace and continue selling, but actually it's a reversal. It continues that trend. And a lot of people are underwater and smoked out for chasing shorts. So be careful with chasing the idea of the news event, because you could be met with this scenario too. If you take the risk of retracement continuation, all I ask is for you to frame your risk properly. That's it. That's all you got to do. That's all I ask. Now, I think we also had a agent session that was successful for Wednesday, if I'm not mistaken. All right, let's take a look at this agent session. Agent session is the same thing. We have a larger dead zone here. Somebody asked me why is it such a larger dead zone? Hey, because that's what happens in between these two kill zones. The last kill zone that I would trade, or if you wanted to trade, would be London close. Try and make something out of that market there. I don't. That's all I can say about that. Agent session, I'm more available here. When we check EJ, we'll give that in a second, right after this agent session. What day? What day this week? Same day? So we're looking for buy side. That's buy side. Looking for sell side. Here. And we got sell side down here. We have the Asian session opening price. Right? Same model, different kill zone. That's it. Asian opening price, or 8 p.m. Some people say Asian session starts at 7 o'clock. I don't start it at 7. I don't start it at 7 p.m. New York Eastern Standard Time. I start mine at 8 o'clock. And that's it. Price runs up, bang. Bang, 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 bang. Takes out that buy side that we labeled. Everything down here starts to become a target. These are potential targets. Right, sell side. We're in a triple confluence idea. Now, technically, the new daily candle already started. Started at 5:03 or 5:04 p.m. not at midnight. The new daily candle does not open at midnight. It actually opens the same day in the afternoon at 5 o'clock. So technically, the true day open is midnight opening price. But if we're going to consider this whole session still one day, the Asian session going into midnight, we're going to consider it a part of Wednesday's day just based on the way it's framed on the chart here. And not what we know. It is above this midnight opening price over here. This one here. It's also the above the other opening price too, but this is the midnight opening price. It's also above that. It's also above Sunday's opening price right there. Another triple confluence while we're going into the Asian session. Let's go down to the 1 minute. We're looking for that entry. And I think this one doesn't form till like 10 something, 10:30 or something like that. This one was a little later in the day of the session. See how patient you got to be? I think it's here. Yep. This is the entry. That's a swing low. Fair value gap. Right, I like the Asian session for UJ. I like to trade UJ more than all the other yen crosses. That's a 1-to-1 scenario. Wait, forward. TP hit. There you go. But you gotta wait. You gotta wait for this one. You gotta be you gotta have real diligence here and persevere all through this bullish trend. Because I know you're like, yes, I want to jump in long. Yes, I want to jump in long. But the conditions right now were showing that it was overbrought. Triple confluence for the Asian session. And there was going to be a potential sell idea. And we framed that right there based on that model that we like. And that sequence, right? That coding. It's all zeros and ones and zeros. It's algorithmic. And we play it all the way through. And we see these triple confluence ideas tend to be very home run trade ideas, especially when they work. And this goes on for what? A couple pips, honestly, without returning back to that stop loss. Just imagine, right? We didn't have a trailing stop. We didn't move it. It's almost 80 plus pips, 90 pips, possibly, right? Even more if it drops lower, 100 plus pips, just based off of that one trade idea. Someone had said in the chat, with the triple confluence, it tends to play out fast. 3 out of 5 times it shows. True. It shows. And this is what I said. The market is very concise and methodical. It knows what it's doing. It's not doing anything random. It's not doing it because it just likes to do it. It's doing it because it has to do it. It's the most logical thing to do. Every time you think about it, logically speaking, it only makes sense to sell high. It doesn't make sense to sell low. And you can see they're selling this. They sell this market off really high. They pushed it all the way into a premium above Asian session opening price. They pushed it very expensive, right? Not cheap at all. Expensive. We don't want to buy expensive, but we rather sell expensive. Yes, we could sell it to other traders at a higher rate. Let the other traders buy it from us at this higher rate because the market's going to tank on them. They're going to buy it and it's going to automatically lose value. They're going to be the loser while we're going to be the winners. Do you see that? For every buyer, there's a seller. For every seller, there's a buyer. We're going to sell back to the buyers at a higher price. And all those other traders, right, let's pretend it's like a real deal occurring, which it is. It's a handshake. It's basically a handshake. The buyer and the seller shake hands, and the order is sent. The buyer and the seller shake hands, and the order is sent. The buyer and the seller shake hands, the order is sent. That's exactly what happens. It can't be just a seller. There has to be a seller and a buyer. Even when the market's going down, they're still buying and selling at the same time. Vice versa. If it was going down, we would want, right, to buy cheap. We wouldn't want to sell cheap. Doesn't make sense. Doesn't make sense. Why would I ever buy something and then sell it cheaper? Doesn't make sense. I'm going to buy something as it's cheap and hope to see it gain value. And if it gains value, I can sell it at a profit. I could buy it down here. While I'm buying it, people are selling it to me. And I think it's going to drop in value, but it's actually going to increase in value. So they got rid of a good or a commodity or whatever. In this case, fiat currency. They got rid of something, right? They started selling the yen and started buying back the dollar at a cheaper rate and pushing it up. That's all it is. Literally all it is. Going into London. Let's see what happens. Does London continue this trend? Look at this triple confluence idea. 100 plus pip trade. 100 plus pip trade, bro. And people say they can't do it. They can. And also, like I said, I say this all the time. That trailing stop. Your trailing stop is going to get smoked. It's going to get cooked. If you trail your stop, it's going to get cooked. It is a very difficult thing to have a trailing stop and not get it stopped out. That is something I think there's no perfection or no perfect way to have a trailing stop. And my personal experience and what I view as common sense. Because if you trail your stop loss, those lower swing highs that you put it above, it's just more fume for the fire. That's it. They're going to run the stops above the highs, right? Refuel again, and then sell. They're going to run the stops above a high and then sell. It's over. It's constant. So you put your stop loss above that high, there's a possibility it's going to get targeted. And it can get targeted and continue to sell off. And it's going to make you feel upset. I've been there. But what I've learned, though, is during certain days, during certain conditions and environment, and the timing is right, you leave your stop loss at its original placement, you could catch more than what you're asking for. All you would have to do is just take partials on the way down. Collapse 50% of the trade. Collapse 80% of the trade, right, as you want to. When the trade gets 10% for my one-to-one scenario, I close out 80% of the trade. 80%, and I hold the other 20. So at least I have some type of collateral if price comes back and I don't move my trailing stop to break even or into profit. Because I paid myself something, a part of this trade. If it moves back into hit that stop loss, I have something to mitigate that loss. It's not a big loss. It's an okay loss. Because I paid myself something. There's some cushion. If it comes back, that other 20% that I'm holding onto the trade and hit that original stop loss, I can live with that. I don't mind. But if I take that partial 80% off and I have that original stop loss and I don't move that 15 pip stop loss and I hold on to that other 20%, man, you can squeeze a lot of the market sometimes. You squeeze a lot out of the market. And that's where people want to really like up their game, right? And really take it to another level. But it's not something you can force every day. These home run trades like this is a home run. Right? If I had to give this this trade description 10 out of 10, right? I had to value it. Man, this is a 12. This is a 15 out of 10. This is an excellent trade. Fantastic trade. But these don't come often. You can't force these ideas though. Everybody wants the big trade, but sometimes it's not clear enough. I know I'm kind of ranting here, but it's really important. Sometimes it's not clear enough. You may not be able to find this big trade in the dead zone. There's no need. We don't have to find that big trade. Many people will argue and say, oh, but what about this leg? Why couldn't we catch this? You're not catching every move. You're going to catch the move that is going to be suited for you and the kill zone that you're trading, first and foremost. And then we go on from there. You can only trade in the live zones. You cannot trade in the dead zones. That's UJ. Someone said, see, laughing. I'm telling you, this is facts, though. Right? I'm ranting a bit, but this is facts, though. You're not going to hear people in the community talk real game like this. I'm telling you. I've been disappointed and what the community offered me as a student, right? Besides like other materials, Larry William, ICT, thankful for them, right? Cool. Kudos to them. Gave them their flowers already. But before that, and anybody else in the space, I didn't see people out there really explaining it and breaking it down to a way that was like, you know what? This guy is on the sun. He talking facts. His models are consistent. He can show me this every other day on any other pair. I haven't seen that from a lot of people. Select handful of people. But I do know we are closer to the truth than a lot more communities or circles. It's not that my community is closed off and it's only to certain people. I'm open to everybody. I'm here to help everybody, no matter what circle you're a part of. Um, yeah, man, that's that's it. Someone said EJ. We'll check EJ. We'll jump on to another pair. It's just a show, right? There's diversity here. We can change it up. We can change it up. Let's see, it was what was it? What day was it? London model for what? Wednesday or Tuesday? Somebody probably was talking about Tuesday. Let me see, because Tuesday looks like an idea. If I had to rank the sessions and what's the hardest kill zone to trade, from one being the hardest and the last place being the least hardest, London, New York. No, it would be London, London close, New York, Asian session. London close, I don't like to trade. Take a look at this Tuesday. Sunday's opening price. Where you at? You're right here. Let's wait forward. All right, it gets close. It gets close. Looks like it really wanted to get that triple confluence idea, but gets real close to the opening price of the weekly chart. Looks like it's only a double confluence here. That's midnight. This is 2 a.m. These are our premium and discount levels without any indicators. It's a very natural indication. The market already is telling you what it's going to do. At 2 a.m., it told you what its overbought and oversold conditions was for the kill zone. At midnight, it told you its true day opening price and its. Can you guys hear me? Technical difficulties. Can you guys see my screen? I apologize. Things happen. Technology's funny. Cool, we're back. Thank you. Thank you, guys. Appreciate it. So what I was saying, I'm not sure where I left off, but what I was saying is we're looking at a whole nother pair. Look at this gray zone again, right? It's a whole. We were looking at U.S. dollar versus Japanese yen. Now we're looking at Euro dollar versus Japanese yen. Tuesday this week that just passed. This Tuesday that just passed. Again, from midnight to 2 a.m., that is no trader zone, no man's land, dead zone, whatever you want to call it, lunch session. You're going to run into a phase of consolidation. I know there are times where you'll get something like this inside this session. You get large movements in here, but it's not something that happens often. You're more likely to be met with this phase in the market at this time period. Understand the market is just not going through the day dilly dallying and doing whatever it wants. It's very specific in what it's doing. It's setting up the day. It's setting up the day. It's already setting up the buy side and sell side for London to attack and destroy. That's all it's doing. It's always setting up the liquidity. It's buying and selling into its own self, attacking and destroying its own self over and constantly. Price raised that sell side. Let's zoom in. Let's see if we have an idea to go long below midnight and 2 a.m. I'll show you guys. This is 2 a.m.'s opening price here. Get it on that chart. This is 2 a.m. or London open. And this is midnight down here. It's 12 a.m. And we'll see if there's an entry that forms below it. Now we're still above Sunday's opening price. Like I said, a double confluence is not bad. It's not excellent, but it's good. Excellent is 3 out of 3. This is 2 out of 3. Let's take a look. Looking for a fair value gap. That runs a swing high. I think it's right here. And it is. Is the one even closer? There might be. Let's double check to make sure that's there. I see. The same thing I would say. This one's a little different because the swing high is on the start of the fair value gap. I don't like this one, but here is another example of it actually happening and respecting it. Still a fair value gap. It's not inside the box. You see how this one looks different? This is the one I normally like to look for. But this one's similar, right? It's like a cousin, right? It's like another sibling. And it's very similar to this one that I like to say. Right? They're like cousins of each other. And in this scenario, in this example, it would have been a nice trade opportunity. Now, you may want to go for this one or go for any shot. You may go for both whenever you see them form. It's up to you. It's totally up to you. But I tell you what I do personally. I wait for this one. But I do see these other ideas too. I do see them as well. It looks like this would have been a missed opportunity, honestly, to get those longs. But look at how it rates one side of the market. Buy side, sell side. Bang. And then there goes the revert back up here. It can't be any more simpler. And again, buying after down candles would be your best friend. Just look at this uptrend. Every time we had a down candle, there was strong response and precedence for price to want to get up and away from down candles. Down candle, like this is the turning point, we would say. See this huge impulse in, down candle, up, down candle, up, 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 down candle, up, down, up. It just fractal. Fractal. That's EJ. Now, we're going to move on to another topic because we did a lot of intraday. We saw some failed setups. We saw some winning setups. We saw a excellent setup, right? Asian session model Wednesday. We could even go Tuesday real quick, right? Just to really showcase more. I will clear this chart. 15-minute chart. Play it forward. Might leave you guys off with that Thursday. I think it was Thursday, yeah. Thursday Asian model. So let's take a look. South side. Price comes down, takes it out. It's below the Asian open. We're going to stalk longs back to that swing high up there. Right, this was the 15-minute swing high. Bang. Some type of revert back up into this. That's what we're looking for. Please, what is the name of this indicator again? No problem. I'll show you right here. Nope, not that. There it is. FX and Asian Session Range by Rob Minty. There you go, my man. That is it. I have a video that shows you the session indicator setup as well. I'll show you how to set this up. Play it forward. No problem, my man. There goes the model. This was the last night. Not last night. The other night. We did this. And I was like, this one was up to the market gods, man. Because, man, this was the drawdown that was like, this looks like the trade is just going to get stopped out. There's no hope for this one. And, man, this one pulled through. There goes your model. Swing high. Fair value gap. It's forming below 8 p.m.'s opening price. If I can show it, there it is. Zoom back in, play it forward. This one was like, man, this one looked like it was over, like right here. Depending on your broker, honestly, you could have had a losing trade. If you have a broker, especially like Owanda, if you have a live account, Owanda, I have an account with them. Owanda spread on the yen crosses are large, man. Talking like 20 pip spread, right? On that account, this trade I did would not work. I would have to use a larger stop loss just to accommodate for the spread. I would have to probably go 30 for 30 instead. And on some discounted brokers that have discounted spreads are little. Talking like 5 pips, 6 pips, sometimes anywhere low 3 to 4 if you have a nice pair for that broker. And this held up pretty nice. 15 pips right there. Bang, came back. Was the region, right? The region, the range that we're looking to buy was pretty on target. This was still a good trade. And we'll play it forward, see how far it goes without coming back down to the original stop loss. News event, I think that was the interest rate decision for the Bank of Japan. They kept rates the same. I said, someone had mentioned in the Telegram chat, what does that mean for like what if they don't cut rates? Is that positive for yen? Is that bad for dollar? Is it bad for yen, etc.? And I was like, most likely it's going to be good. Either it's going to be neutral to good, because cutting rates is not what they're looking to do right now. They're in a hiking cycle. You can see all the other banks are in their cutting cycle right now, right? And cutting, I think inflation is coming down, so there's no reason to have rates high, right? Job numbers, employment is still good, so they're cutting the rates because they're trying to cool inflation, supposedly, right? That's how they're saying financially how the system works. I'm not no expert, so do your due diligence on that, but that's what they say. And Bank of Japan is now raising rates, which is going to bring investors towards the currency. That's why we saw the interventions working. We saw the rate hikes working, right? They jumped pretty big from negative, neutral to basically where they're at now at a quarter. And it impacted the market. They kept their rates the same. Dollar shot down, yen shot up. So you're going to see UJ sell off. So it hits the original stop loss. But some unrealized gains, right? I always like to talk about it because these gains are unrealized. Basically got a 3-to-1, right? 15, 15, 30, 30, 15, 45. Basically almost got a 4-to-1, close to that, 3-to-1. And unrealized gains, at least a little more. So that's pretty cool to see. And that was Thursday. And we say that Thursdays tend to be successful and more rewarding. And it definitely was. And that was nice to see. All right. So next topic, we're going to talk about smash candle ideas. Swing trade this. And we're going to open up. We're going to open up a major first. Start off with a major. Share this screen in TED. All right. So you should be looking at UCAD. We're on a daily chart here. I like the smash candle idea on the daily chart. The lowest I would go down for this model, right? Since everything is fractal, I'm telling you now, the lowest time frame I would go down for this model personally is the 4 hour. I don't want to go anything lower than the 4 hour for this model. All right. So this model, you'll see it on all time frames, even the 1 minute. It's just be a lot more data and probably a lot more signals, especially on the 1 minute. You'll see a lot more signals like this happening. Doesn't mean every signal that you see on the 1 minute is going to be the one that's going to be the turning point, because this model is essentially trying to catch the turn or get close enough to where the markets are going to change direction. So right here is the smash candle, and I'll define to you what a smash candle is. So a smash candle is a candle that, one, closes below several lows. So this candle's close, if we were to draw a line out, you can see it's closing below all these candles lows. Everything that's below that, above that line, closes above it. So that's pretty significant, honestly. And a second thing to it that Larry was said, market's probably in a discount, and it probably rated some type of sell side liquidity pool or swing low. People can't see my screen. Let me see. Can you see it now? All right, cool. So we have a down close candle. Always zoom. Technology, man. We have a down close candle here. This candle closes below all these candles lows. Anything that's above it. Now, when traders look at this, what do you think they assume? Right? Can someone in the chat take an educated guess of what the retail trader, right, or the average trader and what they think in their IQ when they see a candle like this? What do you think they're going to do tomorrow, the next day? What do you think they're going to most likely do when they see a down close candle like this? It's got some size to it too. What do you think that trader next tomorrow? They're going to sell. The trader tomorrow, most likely, they're the most simplest answer, straightforward. Most people you ask in the street, hey, look at this chart for me. What do you think is going to happen tomorrow? Can you take an educated guess? 90% of them are going to tell you it's going to sell. But you're going to have a select few people that are thinking outside of the box. Outside of the box, you're going to say, you know what? It looks like it's going to sell. That's what Larry Williams said in his book too. It looks like it's going to sell. It looks bearish, right? Quotation mark. It looks bearish. It looks like it's going to sell. This is exactly what this looks like. And a lot of these ideas actually form. This here, this one here, this one here, this one here. All these actually classify as a smash candle, technically. All of these here that you see on going down here. Because all it is a candle that's in a discounted range, and it closes below several lows. So anywhere below three to more previous daily lows, or 7 daily lows. This definitely meets the expectation and that variable. And all these other candles too. This one here, this one here, this one here, this one here. However, we're not immediately going long after. That's the aggressive take on it. And I've shown that with the swing trade ideas. And it could also come back to bite you in the butt because you could have some drawdown. But regardless of the drawdown, we would risk properly. What you would do is you would wait. Larry Williams would say you would wait for price to return back to that candle's high. That's your trigger point. This is where you're going to buy. You're going to use a buy limit order. Price is going to go up and you're going to buy in on strength. I don't prefer like to buy it on strength. I like to buy it in weakness. But according to this model, this is one way to enter the market. You'd buy here. Your stop loss placement would either be below the candle's low, the actual smash candle itself. This candle here is called the smash candle because it's going to hypothetically smash all the sellers. Everybody the next day who's going to sell, they're going to get knocked out. It's going to go up. It's going to run. It's going to be dynamic too. Oftentimes, when price gets to that line, that trigger point for your order, it should be flying through that level. It shouldn't be lethargic. It shouldn't fly through the level and then pull back. If it does that, be cautious because I've seen times the signal will form, it looks good, you're in profit for a bit, and then it pulls back really hard. Now, some projection levels. You could go for a 1-to-1, but since it's a swing trade, look for larger, rewards. Look for a 2-to-1. Look for a 3-to-1. Look for a 4-to-1. Any projection higher, any PD arrays too can help you frame that. We have an up close candle. This is a bearish order block. You can use this as an order block that's going to be reclaimed on the upside, right? The buy curve. If this is the sell curve going down, and we're going to tell ourselves, okay, there's going to be a buy curve eventually. And I know many times you guys seen this chart before where ICT had one side red and the other side green. You're going to see the buy curve is going to run back into all these up close candles because these are going to be reclaimed on the upside on the buying curve of this leg. If the leg does happen, right? The speculation is if it does happen. And I love that diagram because it does depict what happens here too. And I love that I'm able to blend in Larry Williams' concepts, both with the teachings, to really get a full picture and scope of how this market truly works. So let's say we're looking for a PD array. We could say this large fair value gap here. We want to see price run into that right here or more, whatever it is. We want to see price run into that. Or maybe these two last up close candles. Anything like that for a projection higher. But if we're looking for a swing, I don't recommend the 1-to-1 swing. It's just a waste of time. You might as well just intraday trade. If you're looking for a swing, look for the 5-to-1. Look for the 3-to-1s. Wait forward the next day. So price opens. Right? Price opens. At some point it went down and then went up and triggered your order here. Now I want to double check to make sure which way it went first because it could have went up and then down and back up. Let me just double check. Odds are it didn't, but I want to make sure. Okay, so the next day the candle opened and it was already down first. So you didn't get triggered until here. Price went back up here. It didn't even trigger it. Technically, on the 1 minute, did not get there yet. Based on what it's showing. We'll play it forward another day. And you see now the market's triggering you. Now you're in long at this point. Play it forward. And this is where we are right now in price. Hit right into that target that you're looking for. Got to take partials, right? You got there. You got more than 50% of your trade. You got to pay the trader, especially the swing trade. You don't want to be giving up these large days where they pull back. Right here. Large days where they pull back. That would suck. You held it all the way down here. Max profit. Come on, cash out. Right? Pay attention. Don't get into these swing trades and you're not paying attention. The days are going on and you just think you're going to come back and the trade's going to be in thousands of pips up. It could be, but that's not a way to be a consistent trader, right? The trader that really deserves it, they're showing up here every day, looking at it, setting alerts, writing things down in a notebook, doing what it takes to be there for the market. It's work, man. This life is work. It was never going to be easy. And that's a swing trade. And that's a smash candle. You even see that smash candle turned into a bullish order block. So I think the concepts kind of lay on top of each other as well. Like, ICT might have been influenced by Larry Williams. I don't know. And, these smash candles is, okay, order block theory. Same thing. It's a pivotal point, and it's also a returning point to sponsor the long. And it was. It was absolutely great. That's a smash candle idea. Now, Larry Williams was mainly looking at these for buy ideas, and we know fractally we can flip it upside down. It can be seen in sell scenarios too. So the same thing we talked about, it looks bearish or it looks like it's going to sell, we're going to look for the opposite. It looks bullish and it looks like it's going to buy. And that means it's close. Make sure my laptop doesn't die on you guys. Its close is above several highs. So let's take a look of a bullish condition. Sorry, a bearish condition. We'll take a look at like something like, I don't know, gold. Let's see if we can find an example of a bearish condition. No, I'm cherry picking, of course, because that's the whole point of looking back and experimenting and looking for these ideas. So I can see one here, right? Just going back, I see the simple one here. Let's just take a look at it. It's in a premium. It's up high. It just rated buy side liquidity pool. And we can see its close is above these highs. All the candles below it have highs below it, pretty much. And the close is above that. So this is an idea. This could be a turning point. But most traders will look at this and say, oh no, market's probably going to continue going up. They could be right. But then there's a small-minded community of traders that are like, market could possibly turn around on everybody and surprise everybody right here. So where would you sell? You would sell here. Same thing that we would have done for the buy scenario, same thing here. So you would sell here on a sell stop order. Or sell limit. I think it's sell limit. Is it sell limit? I think it's sell stop. I always confuse the two. You sell here, stop loss would be there. We're gonna look for any PDA rate down here. So we can even think PDA rates that were already touched. There's a fair value gap here that it could have returned back into. There's one here that price hasn't returned back into. You also have, like I said, you have that buying curve. You got to visualize the selling curve, right? The downside. How would it look like? Probably very similar. It's gonna probably give a up close candle, then it's gonna sell. Give an up close candle, then it's gonna sell. Up close candle, then it's gonna sell. Up close candle, then it's gonna sell. It's the same thing that happened on the buy curve. You see that? Down close candle, up. Down close candle, up. Down close candle, up. It almost looks like it's going up in a straight line, but it's not. The daily, it looks like a straight line. On the weekly, it definitely looks like 2-3 weekly candles going up. It looks like it's in a straight line. 1, 2, right? It looks like it's just going up. But on a lower time frame, it's not doing that. It's not going straight up in our line. It's selling off hard and then running back up. Selling off hard, then running back up. It's not a perfect line up. Play it forward one day, we're triggered in short there. Price crosses that line. And look at the next day, it crashes through. I like to see the first day is triggered, though. A real strong sell. I would have preferred this second candle that formed here on Wednesday to be the candle that formed here on Tuesday. A strong down close candle. This gives me a lot more confidence in the market. And you want to see that market sell off. And that's what you got there. So you got that little sell side curve, right? Buy side curve, sell side curve. It's not perfect. It's not always going to be picture perfect like this because there's examples where price does come and stop us out and you take that loss. You got to learn how to mitigate the losses and move on, flow with the punches and make it back and stay into the game longer. It's all about maintaining your equity. It's a marathon, not a sprint. How many trades can you get out of your equity? It's not who can blow the most money quickly and make the most money quickly. You're definitely going to just piss away a lot of money. It's about who can maintain the equity longer. Are you going to give it to trader A, who is very has a high risk tolerance? They love to risk. Or are you going to give it yourself to trader B? Moderate risk, reduces risk when they take losses, doesn't over leverage, knows how to mitigate losses. You're most likely going to go with trader B to trade your money, right? If you had to pick two traders, who would you give your money to make you money? Trader B or trader A? Most likely trader B. It's a safer bet. Some people would pick trader A because they like to risk, right? Might be something personality-wise. Something about them likes to risk. They're go-getters. They don't mind losing a lot of money. or they might have a circumstance where they have a lot of funds coming in and they could do that. Right? Everybody's scenario is a little different. That was a sell scenario. Now the same thing can happen on any other asset class. Let's take a look at Bitcoin. Actually, no, let's take a look at Ethereum because I just want to change it up, something different, right? Let's look at Ethereum. Let's look at any smash candles that we saw. Look at this sell. All right, there's one here. Once you see it, you can't unsee it. Once you teach somebody this model, you can't unsee the model. It's just up to you to take the shot and see if the shot actually works. This one here. It's pretty easy to find one because if you find the huge turning points, it's a smash candle that likely started it. There. Look at this candle. Makes everybody think, yo, we're gonna continue pushing up. We're gonna continue pushing up. But Larry Williams, in his book, he also noticed, right? There's a little price action sign. Naturally, he started to say when the candles start closing higher into their candle, there's a sign that the market's probably exhausting itself. The higher it closes, the more likely it's going to turn around. So if you start to see the daily candles and the weekly candles closing higher for the day and closing higher for the week, be prepared for a reversal possibly. Same thing vice versa. If you start to see the down candles close lower into the days or lower into the weeks, a lower close might be a sign that the market is really squeezing everything out the market, going down, and then you're going to see this turning point. It tips over. And that's what happens here. Right there. This is where the trigger point is. Trigger then short. Stop loss above this high. Right here. Not the fib. Short here. Stop loss above that high. And you're going to project whatever level, 1-to-1, based on that stop loss and that entry. 1-to-1, 2-to-1, 3-to-1, 4-to-1. You frame that out. And you look for your ideas for price to draw to. Now, for this model, I would do a day. What I would recommend is a day TP, how long you should hold it. I would do anywhere from 7 days to 20 days. That's what I would do. That's a rule of thumb of mine. Next 20 days, see what the market could possibly give you. And let's see, 20. So first one was 7, right? 7 to 14 days. Let's just say 14 because 14 is a good number. Within 14 days, look to take something off the table or get out that trade. Maximum 20 days. Pay the trader. You see this market continues to sell off. Doesn't get to whatever level I have drawn idea how it's selling off. It creates another idea right here. Here, looks like it's going to go up. All the traders are like, oh, it's going to break out. It's going to break out. Then all of a sudden it drops down. And look at where the close is. The close of that candle, again, it's higher up into the day. It's not like the candle opened, shot up, gave up all its gains, and then there's a wick, right? There's a huge wick or a huge tail. No, it's closing all the way up here. It might have pulled back, pulled up, pulled back, but it closed really high from where the high of the day was. Sometimes the close might be the high. Sometimes the close might be the low. You see that once in a while. And there's a turning point. There's exhaustion that comes into the market. Little things that you can see and notice. See the same thing for S&P 500, right? Stocks. See the last sell-off here. This candle closes above 1, 2, 3, 4. 4 candles it closes above. That meets the requirement, right? 3 or more. Price gets back down to that candle's low right here. Look at the turning point. Turns around and it sells off. Creates this leg. From that entry, from that day up forward, move forward. Let's go 20 days. There you go. 20 days. Look at where it sells off. Every 20 days, the market is going to make an attempt to target a new liquidity pool or continue its initial trend. I say this every single month, normally at the beginning of the daily updates for every single new pair that we trade per month. Every 20 days, the market is going to be seeking buy side, sell side, or it's going to be continue with a trend or moving sideways every 20 days. So 20-day rule of thumb is a good idea for traders to understand what the market might do. It's a cycle. And that is our smash candle topic. We'll move on to another topic. Gotta drink some water. Okay, cool. We're gonna review this, and this will be the last thing, and we'll get into some Q&As if anybody has any questions. So look at GJ. I was a little more aggressive than most people, but I was a little reserved. I brought at that candle's close instead of the high, because Larry Williams recommended the high. If I could get a lower entry based on the idea, I will buy at the close, right? Or I'm sorry, the open of that candle. I could have brought at the high of that down candle, but I decided to place the buy stop order there instead. Place that buy stop order there and look to see price going higher. Now, I said there's two ways you get into the market with those orders: buy limit order or buy stop order. You can use a buy limit order here, buying on weakness, but I wasn't sure. Again, I wasn't fully sure if the yen crosses was going to make a strong pullback. That was my sentiment. I was saying, okay, eventually we're going to get some flowing back into the other fiat currencies, and yen will slowly start to have a sell-off at some point. And we did get that. And I did it after this down close day. At the beginning of the month, though, we did have a smash candle. That's why I have this line here. I had a line here just showing people, for those that remember, this was a smash candle. It's exactly what I just showed you guys. It's a candle that closes above 3 or more previous daily highs. You could have sold right down here at this candle's low, and it sold off. I'm doing the same thing, but reverse for the buy scenario. Let's reverse this. This is the setup. Look at the candle. It closes below these lows. 1, 2, 3. That's all it has to do. Close below 3 candles low or more. 3 to 7, let's say. And I just waited for price to turn back around and trigger me in long. And then you can see that's why I was in drawdown. There wasn't much to talk about. I wasn't doing no daily updates because the market was kind of just ranging. I didn't really have much to talk about. There was intraday setups, but I try to mainly give you guys short and concise videos for the daily updates. And then the market started to come back. Fed cut, dollar went down, pound probably gained a lot of strength. So it was amplified into GJ as well. And GJ ran up. And what a great trade, honestly. Again, every single month, I always try to find at least one swing trade. You could do it. It's possible. There's 12 months out of the year. Let's say three to four of those months you don't take, right? So that means 8 months. You can possibly find 8 swing trades. And out of those 8s, right, there might be 3 that are real strong bangers that pay you enough for whatever you need, right? A chunk of money. Make 20 grand, make 30 grand, make 40 grand. I'm not saying it's easy, but it's possible in due time. You just stay consistent. I believe in myself. Hopefully you guys believe in yourself too. It is possible. Whether you become a full-time trader, whether you become a part-time trader, whether this is supplemental income on the side, you already got a full-time job, you do what you got to do, you own a business, but then you come home or you whatever time at day you jump in and now you're a part-time trader, you clock into another job. So you're making your money work for itself, right? You take the money that you make from your job, right? Whatever skill or asset you use to be some type of, law-abiding citizen that helps out the community, or your job is, whatever. It creates some type of service. It helps solve some type of problem. You're making money that way. Cool, right? You're an educator, right? You're a professor. You're a mechanic. You're an electrician. Whatever it is, you're a barber. Whatever job you have per se, right? Mailman, mail lady, whatever, right? You take that income, take a little small portion of it, and you try to make it work for itself, right? That's it. That's the whole goal. That's the only way you could get ahead. Now, when it comes to day trading, I don't think you could day trade your way to freedom, because you have to show up every day to day trade. But I think wealth is really made through swing trading, though. That's my personal take. It's debatable. Some people might disagree, and I'm open to having that talk if anybody wanted to debate that. But I do think swing trading is less stressful on the mind and allows you to step away from the chart, so you don't have to feel those feels of anxiety, or feeling like the market's against you. You can take a break for a second and you can reconvene and reconnect with the market every 3 days. How's this trade going? Oh, it's actually not going so well. Oh, that sucks. Let's put the phone away, or let's reevaluate what we think about the trade and go from there. Do we cut our losses and then wait for another signal, or do we continue to believe in the trade and hold on to the signal and come back in another couple of days and see where it's at? That's what I did with GJ. I told the paid group in the Discord channel, I said, hey, I wasn't sure if I wanted to hold on to GJ. I said, by the end of Monday, I will know if I want to hold on to this swing trade. And by the end of Monday, I was convinced. I was like, you know what? This trade actually still can hold up. I think we're going to get a higher swing low. Price is going to fail. Right? My guess was price is going to fail to break this swing low that it formed. 1, 2, 3. It was going to make a higher swing low, and it did. And Monday pretty much was my deciding factor to continue to hold this trade. It created a higher swing low, 1, 2. I was anticipating this candle here Tuesday. Don't run Monday's low. I want Tuesday to run Monday's high and confirm a higher swing low, or just confirm a swing point, right? A new bottom, and push away. And it did. It printed a down candle again. Right? You could buy again. If I wanted to buy again into this model or into this idea, I could have been a risk taker. Buy again. Buy after this down close candle and wait to see price push higher. And that was just basically how we were able to catch that GJ trade. If there's any questions, please ask now. If not, you can email me. You can text me on Telegram, Discord. I'm really accessible. Please do not fall for the scammers. Recently, there's people that have been trying to impersonate me. Everything is through me. You guys got my username. It's not going to change. If it does ever change, I will let you guys know. Just be careful. That's all I'm saying. Got people impersonating me, trying to scam people. Be careful. It's not me. Absolutely. Yeah, we could do a 101 next week. Absolutely. We'll do a 101. Like I said, if you want to be a part of the paid group, we do 101 sessions. We do live trading with the paid group. We do mainly New York sessions because that's the time I'm available before I head out of the house. And we do Asian sessions, and sometimes we have random Zooms just to discuss and talk about my recent findings or things I might want to discuss. And I think brings alert to my community. So if you want to inquire about that, please let me know. I'll send you a link. If not, I will see you guys next week. New week. We got this. I love you guys. And yeah, peace. I'll be posting this on YouTube. All right, cool.